can take a big chunk of your retirement portfolio, instead of using a 3 or 4 or 5% withdrawal rate, you can just put it into something that yields significantly more than that. But digital credit, I think, has a lot of promise because it's built on something that is much more pristine than the traditional financial system. But I still think Bitcoin is going to $1 million, probably by 2033 or 2035, something like that.
Mike, thanks so much for taking the time to record with us.
Yeah, great to be here. Good to see you again, Joe.
Absolutely. Thanks for hosting us as well. This is incredible. Let's start off broadly. I do want to talk about, obviously, Bitcoin and digital credit. But first, I want to know your general investment philosophy.
I think at a high level, I'm a sort of high conviction, long duration value investor. I like to take large positions relative to the size of my overall capital in companies where I feel like I have some sort of edge, either because I know the business better, I know the strategy better, I know the team better. The team has been a key determinant for me many times, where I'm able to look at a set of 20, 30, 40 companies, let's say in an emerging industry, and sort of handicap the likelihood of having success as a shareholder in those companies. Just a little bit of pattern recognition, a little bit of human psychology. And I've just had a good track record over a long period of time of being able to pick out kind of leading CEOs, founders, management teams. But I like to hold stuff for as long as possible. So ideally, when I find a good investment, I'm able to enter when people are extremely bearish and negative. A good example would be when I was buying Strive last spring, about a year ago. Everybody was losing their minds over all these new fangled treasury companies, and they were willing to chase at much higher multiples of the underlying Bitcoin. By the time I was interested, those premiums had largely gone away. And the sentiment had gone from too exuberant to then sort of too negative. And if I like the long-term trajectory of a business model, then my preference is to see those opportunities when people are the most afraid, because that de-risks, right? So partially de-risks the investment opportunity, because if you're entering at the right price, it's harder to lose money. I also look at the balance sheet, right? So I'm very much a balance sheet first investor. Like if I can't understand how I'm not going to lose money in something, then I probably won't get involved right, at all. And so if you look at a balance sheet, for example, with a company like IREN or Cypher 2-3 years ago, like they own sites that were worth more than the market cap of the companies at that time. The sentiment was extremely negative. We were coming into the landing in the Q4 of 2022, crypto bear market, NASDAQ bear market, right? It was a tough time for investors. And that was when you could actually buy those stocks with like a pretty good intrinsic value margin of safety, right? So you were buying them probably for about a third of what I estimated that the value of the sites was at that time. And that's if the business wasn't successful.
Yeah.
And so those are the types of situations I like high asymmetry, protection on the downside via the balance sheet, business models that I maybe think I have an edge in the market, and world-class management teams. And if I find those types of situations, I size those positions up, that it's actually pretty hard to lose money over long periods of time. In fact, you might actually compound at much higher rates than most people are. I mean, I'm targeting 30 to 50% type returns over long periods of time, which you can't do if you have like 75 stocks or 75 investments in your portfolio and they're all sized at 1 to 5% type of thing. You're sometimes going to have to be 40% or 50% long one idea, maybe even higher, depending on where you think you are in the cycle, in order to achieve those types of CAGRs. But if you could do that for 2 decades or 3 decades, then you're basically drunk and knowing.
Yeah.
Right.
Fair.
And it's harder and harder to start a fund now that looks like that, because everybody's looking for Millennium and Citadel and things where it seems like it's like guaranteed with a low volatility because the risk parameters are so tight. So they're managing for like 10 to 20%, but like every single year. And if anybody in the pod goes off track, they just cut the risk right away. So they're selling stocks when I'm buying them because that's part of their model. And their model works for them. And that's a lot of people want low volatility. That's why people get sucked into Ponzi schemes, by the way. The Ponzi's usually look like super low volatility, like 18% every single year or something, right? And that's usually not real because it's basically impossible to do that. But a lot of the pod shops have been able to emulate that type of return string by diversifying the risk across a number of teams and then cutting risk whenever somebody draws down, let's say, more than 3%. To do what I do, you have to be willing to draw down 30%, 50%, and you might even do that several times in a cycle. But again, if you really know what you own, maybe you can hold those positions. So it's very much like a point-to-point style. Like if I close my eyes for 3 years, if I know the price in year one is is $1, and I think the price in year 3 is going to be $5 or $10, which is approximately what you need to do in order to generate those types of CAGRs and higher, then you could close your eyes as long as you're right? Because the stock might go from 1 to 2 to 50 cents to 3 to 50 cents to 4 to 75 cents to 2 to 1 to 3. And if it ultimately gets to 5 in year 3, then you got your 5x return.
Yeah.
Right. So anyway, that's kind of how I think about some of this stuff.
Yeah. I've always admired your long time horizon and the ability to maintain like conviction when throughout that extreme volatility. What do you think like most people get wrong when it comes to markets and investing?
I think a lot of people don't really have the end goal in mind. So it's easy to get whipsawed if you don't really think about, well, the whole purpose of this exercise is to have more wealth in the future.
Yeah.
Right. So whether the market gives you a mark-to-market gain today or tomorrow or next week is irrelevant. People want to feel richer. They want to feel better off. And so they'll trade. Too much will get sucked into whatever's hot or whatever is sexy right now, whatever's going up, whatever looks good on a chart. And that's not, in my opinion, the best way to make money. The best way to make money is to really keep the end goal in mind and focus on your longer term outcomes over 3, 5, 10, 15 years. I see people on X, they're 25 years old and they're trading around like they need to retire by 27.
Yeah.
Now, if you needed to retire at 27, maybe reduce your risk and hedge and use put options and do whatever you can to keep your account balance stable. But if you're not going to be retiring and using that money for 20, 30 years, why are you acting like you need it next week?
Yeah.
So I just think there's a mismatch sometimes between what people are actually trying to achieve or what they should be thinking about trying to achieve and what they actually do. And so I think if you start with a crystal clear view as to what the objective is, it makes it easier to reverse engineer how you should be investing. Mm-hmm. So as I said, for me, I'm looking for 30 to 50% long-term CAGRs, like 2 decades, 3 decades, 4 decades. So I can't afford to sell everything every time people are freaking out on the internet. In fact, I probably need to do the opposite. I need to be generally buying every single time people are freaking out. And it doesn't even matter what it is, because every single time people have been freaking out in markets for the last 100 years, the market always comes back.
Yeah.
Even like 2008, right? Like everything's collapsing. The global financial crisis is going to kill the global economy. And we bottomed in March of 2009, one of the best buying opportunities in the last 25 years.
Yep.
Everyone was told, oh, you got to be careful, right? You got to be careful. Everyone always tells you to be careful when you actually should be adding more and investing. So I'm able to understand that over a long duration. And I never let anything that's happening in the very short term change that view. So like more recently, like with this Iran thing, like Strait of Hormuz closing is going to end human civilization. It's going to send oil prices to the moon. Like you should sell everything. Everything's going to go lower. There's going to be a global margin call. A couple of years earlier, it was like Silicon Valley Bank and Silvergate and everything going down because of mark-to-market accounting on bond portfolios is going to kill every bank and crash the global economy, right? You go back to COVID. Oh, this virus that basically causes a flu is going to kill the global economy. They're never going to open it up again. And so you're an idiot for owning stocks every single time. I can give you like a dozen more examples just in the last 10, 15 years. Every single time was a time to add. Yeah. But if you read social media and you read the news and you listen to Jim Cramer on CNBC, these guys always get you aggravated right when you need to be super calm and making additional investments. Mm-hmm. So I just try to remind people on X, like every time this stuff happened, they always say, Mike, it's different. You don't get it. It's different this time, every single time. And I'm like, nope, check back with me in 6 months. Yeah. We'll probably be higher again. And even if we're not, then you get 6 more months to act. Yeah. And then 6 months after that, we'll be higher. Yeah. The longest major drawdowns in the indices, right? Like 2000 to 2002, for example, in the NASDAQ, like that was pretty painful. People who just held tech stocks through that period lost a lot of money. But if they bought them in 2002 or 2003 and held them till now, they obviously crushed the market over that period of time. Mm-hmm. So you basically just have to buy high quality stuff when it gets cheap. Yep. And the thing that causes cheapness in the market is usually people being afraid. So when people are afraid, I use that as a kind of a key heuristic for when I should be thinking more about buying, like thinking with more granularity about what's actually cheap and looking more carefully as to what's available at what price.
How do you know like when the peak level of fear might be, or does it not even matter to you? Like you don't necessarily know when it is, you just try to keep adding when there is fear.
I think in markets, sometimes it's better to be approximately correct or directionally correct rather than trying to be precisely correct. Basically trying to be perfect is the enemy of of great success in markets, because you're never going to be first. It's just like golf.
Yeah.
Right. Good golfers, like, it's really minimizing errors more than being perfect. So like, even when you have a bad shot, it's less bad than the other guy's bad shot, right, over long periods of time. And I think it's the same with behavioral psychology and investing. Like, you generally want to do the right thing. Like, if you look at your last 10 years, when people were afraid, did you take the right action at approximately the right time? Not did you buy every stock in your portfolio at the absolute low and trim it at the absolute high, but did you generally buy high quality stuff when they were cheap? And did you generally trim or rotate from things that were expensive? And I think sentiment is just one heuristic, right? But it is pretty all encompassing. Like, you can see it in the VIX, right? You can see it in options positioning. You can see it in a bunch of other like technical metrics you might use as a more technical trader. You can kind of see that sentiment is negative, and it doesn't really matter like, how long that period lasts necessarily, as long as you have the capability to consistently add through that period. But I think X is actually a useful tool. I've mentioned this many times. Like, I mostly use X to gauge that. And I have my kind of like proprietary list of accounts that have proven to be absolutely terrible at inflection points. And I monitor those accounts. I monitor the situation every time we're in a so-called crisis, because those accounts tend to freak out the most right at the time you should be buying. And some of them have almost perfect track records of being bearish at the bottom. And so if you get an aggregate view like that, and then you also kind of go out in the real economy, talk to people, you can get a sense for what's going on. And one of the things I noticed in the last 3 years is a lot of people got bearish on X because of things that were largely technical, but nothing actually happened in the real economy. Like, I've been posting for 3-4 years now, there's not going to be a recession, because every time I go anywhere, every restaurant is packed.
Yeah.
Like, people are spending money, and they're like, Mike, that's just the rich people. It's all credit card spending. I said, I don't think so. I think you're underestimating how strong the economy is, because your fundamental mindset is negative and pessimistic. And so you're always looking for things to fill in to explain why you're being rational and being negative. The truth is that over long periods of time, all the real money that's made in markets is made during periods of time where other people are afraid, right? So like, the world's been almost ending for as long as markets have existed, and the world hasn't ended yet, but people who stayed long made a ton of money.
Yeah.
And that'll continually be the thing. Optimists will make most of the money in markets. People who stay positioned will make most of the money in the market. Certainly there'll be counterexamples like firms like Jane Street, where they're just on all sides of everything, or some of these pod shops, like I mentioned, like they'll do fairly well because they're just taking a tax basically on the whole system. But long-term fundamental investors will outperform day traders, right? Just as a general rule over long periods of time.
Yeah. What did you do before you first learned about Bitcoin, and like, how did you discover Bitcoin? What clicked for you?
I mean, I was a software entrepreneur, so I had a couple of different software companies. I had a little bit of a financial background, did a little bit of like personal financial management, which taught me a lot about how individuals think about investing and retirement and risk management and insurance and things like that. But the whole time, the thread is I've always been interested in investing since like the late 90s. And so the question is, it will sort of remind me of like where you're going with that.
Just like, what did you do before Bitcoin, and like, what was the catalyst for you understanding like why Bitcoin is interesting?
I was just watching Bitcoin for years, because coming from the technology side, a lot of the VCs were really excited about Bitcoin.
Yeah.
It was as far back as like 2012, 2013, 2014. And I just made the mistake of dismissing it at that time. I've said this before, largely because I didn't like the people who were telling me I should look at it.
Nice.
So I made a mistake. A mistake I've largely corrected now behaviorally, where I'm willing to change my mind or take a look at something if there's enough there, or there's enough that I can pull the thread and start to dig into it more. So I finally like started to pay closer attention in like 2015, 2016. And I considered putting a large chunk of capital into Bitcoin in Q4 of 2016, but I didn't actually do it until spring of 17. And it was really just finally starting to understand that Bitcoin was this decentralized, immutable thing that what didn't look like any other thing that had ever existed, because almost every thing that was held out as money in human history was issued by some sort of central authority. It was controlled by some central authority. It was very hard, especially for older people, to get their mind around the idea that there can be a system that nobody's actually running, or nobody specifically is able to control. And I just thought that was a really interesting idea. And I started to figure out that like, if you can't turn it off and you can't control it, and it is harder from a scarcity standpoint than than the currency that it's being priced in, the US dollar, let's say, if you're in the US, then over time, it's basically algorithmically sort of designed to increase purchasing power over a long period of time. And I think where people get confused on the behavioral psychology side is they see the price of Bitcoin moving and they ascribe that to some sort of flaw in Bitcoin itself. Well, it must be risky. The government's going to shut it down. It must be because criminals use it. It must be because it's manipulated. When in fact, Bitcoin is just merely reflecting the volatility that exists in the fiat system, a system that is largely, again, controlled by politicians and central banks and is highly manipulated because they need to control the issuance of the currency. And if political requirements require them to print more of it, then they'll print more of it, right? And so Bitcoin doesn't do that. It just follows its own path. But because it's priced in dollars and we think of it in dollar terms, it sort of reflects that volatility from the dollar system back at the market. I think that confuses people. They look at the way Bitcoin trades versus the NASDAQ, or they look at the way the Bitcoin trades versus most equities, and they say, well, Bitcoin must be riskier because it does this BART thing, and it seems very algorithmic, and well, that's a free market. That's what happens when you don't have the government in there like trying to incentivize people to do certain things. Real estate seems super stable because the government gives all these tax incentives. The US stock market seems really stable because you're incentivized via 401k savings, which gives you a tax break. So that incentivizes you to put it into basically index funds, which is what all the 401k platforms are sort of shoving you into. And so that creates an automatic flow into large publicly traded equities, which makes them look maybe safer than they really are. I think true safety comes from the margin of safety of buying something below its intrinsic value. But a lot of more casual investors think safety is how volatile the price is on a chart.
Yeah.
So if they see it not moving, then they think it's safe, even though they're not going to beat inflation, right? So I like to say, if you really want to avoid volatility, buy a CD.
Yeah.
You can get a guaranteed loss of purchasing power over time, right? Because the things you actually want to buy are inflating at 4, 5, 6%, and you're going to get 3%. So they think they're getting it because they see more dollars in the account, but when they actually need to go spend it in 10 years, they're going to realize there are less there. So I think a lot of people are just not attuned to the real underlying risk in markets because they're so focused on the here and now. It's like tunnel vision. I can only see the price on the screen now and my portfolio value now. And they're not thinking like 5, 10, 15 years out. And I think that kind of time arbitrage of thinking a little bit more carefully about everything across time, right? And sequentially, and thinking about how you're going to feel 2 years from now, this month, or 6 years from now in July. Like, if you could actually visualize that perfectly, it would, and most people can't, because again, they're just going to work today and picking their kids up and reading social media and doom scrolling and stuff. Like, they're not able to actually do that kind of thinking. If they did, it would make it easier to make better decisions.
Yeah. Speaking of flows into different assets, digital credit is obviously becoming a lot more popular.
Yep.
STRC has had major success. What do you make of the success that we've seen with digital credit so far?
Well, I've been watching it very closely. I do have 50,000 shares of SATA that I bought. I think my cost basis is like 93, 91. Could be better, but ultimately it doesn't matter, right? Because it's primarily like an income instrument. If you were intrepid enough to buy them when they first came out and people were more afraid about whether they would be able to make those payments, you could get a lower price. But I still think at 11.5 for stretch and 13 or even more, right? Recently, if you bought it below 100 effective yield, like, you're getting something that you can't get very easily in the rest of the income market, right? So you're really competing against bonds, dividend stocks, or short-term loans. Like, you're competing against other asset classes that, to do those safely, like, you typically have to stay below 10%. And so the argument from TradFi will be, well, these yields are too high, they're not sustainable. And that may be true if it's based on the dollar as the underlying, the underlying center of the universe. But these products are largely, in my view, like, built on Bitcoin, in the sense that if Bitcoin performs in dollar terms the way many of us model that it will, let's say 20 to 50% CAGRs over the next 10 years, then theoretically you should be able to make those cash dividend payments to the preferred holders indefinitely. And that solves a big problem for a big chunk of US savers in particular, who don't have enough saved for retirement to live the kind of retirement that they want to have in the same place where they currently live. Like, if you live in La Jolla, California, or if you live in a suburb of New York, or if you live in Seattle or something like that, cost of living isn't going down. If you saved $1 million, you may think you can have a comfortable retirement there. You may not. You may need to move to to Wyoming or Tennessee or somewhere cheaper. Or you can take a big chunk of your retirement portfolio, instead of using a 3 or 4 or 5% withdrawal rate, you can just put it into something that yields significantly more than that. So like one of the things I just did with my mom recently, we went through her portfolio and we identified a bunch of dividend stocks that we had purchased at lower prices. So the effective yield, the yield at the time was, let's say, 5 to 8%, and some of them are now 3 or 4 because the prices have gone up. Stuff in consumer staples like tobacco stocks and energy MLPs and stuff like that. We were able to take basically a basket of stuff that was probably a blended yield of like 4% and move it into SATA, the Strive preferred at like whatever it was, 13% at the time. I think she got like 90, just under 98, like 97, 90 or something like that. So she's already up 2% on the units, right? Plus she has, the yield, which is going to come at a higher cadence. So I think it's a really interesting product. And if they really work, they probably will take a lot of share from traditional income instruments. Like what's the point of buying a bond with a 3 or 4% yield? It doesn't really solve a huge problem for a lot of people. It doesn't help them get to retirement or have a better retirement. And so I like the space. I mentioned on X that I was just with Fong from MSTR last night, and we had a nice conversation about this. And so I the more I talk about it, the more I think about it, the more I use these products, the more I'm constructive on them. There are risks, right, as there is with any high income product, but I think the risks are somewhat mitigated if you really understand Bitcoin. So I think a lot of traditional investors are sort of underwriting it as just a classic like vulture capital instrument where we've got this money, we can buy this thing at 98, 99, 100, whatever, and we're going to get, let's say, approximately 1% a month. And so we could put a stop loss at 96 or 97, and as long as they pay it for 3 or 4 months, like we're in the green. If things go better than expected and they're able to pay it indefinitely, great, but it's liquid. So if we change our mind and we decide we don't like the way the balance sheet is headed, we don't like the direction Bitcoin price is headed or whatever, they can cut risk very easily and avoid losing money. And so I think what'll change though is if Bitcoin starts to go back into a bull market again, now you'll start to have people start to ask questions. Well, what if the Bitcoin price goes up a lot? Like what if it goes up to 200,000 or 300,000? Like should these things trade above par? Like will they be able to lower the yield and still keep the same demand, right? Because a lot of the yield today is higher to incentivize people to kind of take a risk on a new product where it's less proven. But maybe in a year or two from now, right, like Bitcoin's higher and people are able to see a path for these things to be paid for a long time. And the thing I do like right now is it looks like there's a pretty hard threshold of $1 billion market cap. And over $1 billion market cap, there's certainly a lot of companies that could issue preferreds, but there aren't that many that are going to take that risk or even understand or be interested in this sector yet. There are a lot of people that are smaller that would love to do it. They would love to follow MSTR and Strive, but candidly, in this environment, it's going to be very hard for them to get their market caps up, and they'll be competing for mind share with companies that already have these things issue. So it's an interesting time. Like it'll be interesting to see what happens from it.
Yeah. How do you think about portfolio allocation when it comes to like growth investing, like the treasury companies themselves, like the common stock and the AI companies and the miners, compared to income investing, more of like stable, high yield type product like digital credit? Like, how do you think about where to allocate capital and when to do each?
I think it's a very individual thing. Like for my mom, who's using that money to live in retirement, she's much more heavily weighted towards things that pay you. Right. So that's kind of one bucket of people, those kind of retirees and because I advise informally, like my mom and my father-in-law and stuff, like I'm always thinking about these types of investments. But then there's just sophisticated investors who are actively investing who are always going to maintain some liquidity. So you're going to have access to liquidity via margin, right? The things that are lower risk and lower volatility, the broker will give you more margin on those instruments than they will on high growth or small cap or crypto, right? It's like they think those things are risky, so they're not going to extend much credit around that. So you always need to maintain some liquidity as an investor because otherwise you don't have anything to buy with. So people are always like, well, why not just be 100% in Bitcoin? It's like, well, Bitcoin doesn't generate any income. And so I'd have to sell it in order to buy something else or to take advantage of dislocation in the market. And so I think these instruments can be useful to institutions, right? 12 or 11, 12, 13% return is good for a lot of different types of investors. Not everybody's trying to get 30% or 40% a year. To me, they're somewhat defensive, right? They performed pretty well during the period of time like that Bitcoin's drew down from 125 to 60, right? Like they weren't trading at 100 most of the time during that window, but they didn't collapse, right? And then they firmed up even as Bitcoin was still down in the 60, 70 area. They firmed up because people started to realize it's just a math problem. Like, is there enough liquidity there to pay these yields? And if there is, then the products will work. And if there isn't, they won't. But I think people are gaining confidence. That they will.
Are you surprised that, last year you peaked at 125 or whatever, and then Bitcoin did fall to 60K? Are you surprised at the resilience that digital credit had, or did you kind of expect it?
I mean, I owned it. So I was obviously betting that the fear about it was not going to last, right? Because, when some of those purchases on SATA were below 90, like 88, 89, some of them were 90, 91, 92. I tend to dollar cost average for months once I decide to take a position. That way I can capture prices over time as sentiment changes. And so I was comfortable just continually adding. And when I finally stopped adding, it was 93, whatever, 91, 92 cost basis. So like I was adding there because I thought the market was wrong. But the market was trading at 93 because people thought there was some risk that they wouldn't be paid. And I thought I was pretty confident that they would at least be paid for 2, 3, 4 years.
Yeah.
Because my view now is like, even though there's some optionality that companies don't have to pay, that effectively the business model is predicated on them paying. If you have one of the preferreds and you don't pay, then you've effectively destroyed the one component, in my view, of the treasury company model that is, I think, proving to be a real sustainable flywheel. Because there's real product market fit. There are a lot of people who need higher incomes. And so I think over time, as people realize that these things are going to get paid, they're probably going to trade at 100 a lot. They may trade 100 for the whole month. Or higher. I mean, you don't want to trade too much over 100 because you want the companies to buy more Bitcoin.
Yeah.
I mean, you really believe in Bitcoin. It's interesting because I don't think you necessarily have to believe in Bitcoin to buy these things. But in the long run, if they work, you might as well have believed in Bitcoin, because if they work, Bitcoin will go up too.
Yeah. Yeah, it's definitely a fascinating instrument. What would you say to someone that sees the high yields and like the relatively stable price and like, this is too good to be true?
I mean, I would advise everybody to consider the risks, right?
Yeah.
I'm not recommending these to everyone. I had a good conversation with my mom about the risk and the potential reward. She kept a bunch of her energy MLPs, and she didn't sell any of her EPD, for example. And we only trimmed British American Tobacco and Altria a little bit, right? We cut some of the other staples names more. And so it wasn't an all in or all out thing. It was like a portion of the portfolio, right? But that portion of the portfolio, because it's paying 13%, punches above its weight and increases the blended yield substantially. So the only reason you're getting that yield now is because there is some risk, and it's some risk that's probably above, or at least perceived risk above, the risk of buying Pepsi or something. But because I know Bitcoin so well, I'm confident that it will probably, especially from a 70K or an 80K starting price, probably compound at higher than 10 or 15% over the next 10 years. I'm pretty confident the yields get paid. So not an endorsement. I'm not recommending everyone run out and get it. I especially don't think young people should be buying them as much, because you'd be better off just buying Bitcoin and growth stocks, right? If you're in your 20s and 30s, and you have 20 or 30 years to invest, you're not going to get rich on a 12 or 13% yield, right? So like generally it's going to be better suited for people who are already rich and they want to stay rich or want to increase their income. And so for people like that, for a portion of the portfolio where they're comfortable with taking some risk, again, the risk is somewhat mitigated because you can always sell. It's not like you're locked in. You're not betting on it forever. You're betting on it for as long as you feel comfortable that those yields will be paid.
Yeah. How do you think it compares to like the turbulence that we've seen in private credit, where people have been trying to withdraw their capital and digital credit actually being liquid? How does it compare?
Well, I mean, the underlying asset is a 24/7, 365 liquidity. The old issue in private credit is that the underlying assets were not marked to market for years. So like a lot of it is centered around software. Software companies, a lot of software companies in 2022 went down between 30 and 99%. Right? Companies like Carvana went down like 98%. Netflix and Meta were down 70%. People forget that. It was only a few years ago. But the private software companies that are the closest peers to some of these big tech platform companies and publicly traded technology companies generally, they never got remarked because maybe they didn't need to raise money. So the way private assets get marked is whenever there's a transaction. Sometimes there's no transaction in private equity companies because one private equity company bought the company 6 years ago and they don't need to sell it right now. So they can just mark to whatever the last mark is and ignore the public company stuff for a while. And so that creates kind of false incentives and false pricing and false expectations. You've got managers who, private equity managers who still want to generate their fees and they still want to raise their next fund. So what's the incentive for them to go tell their investors that they actually think some of the companies in their portfolio are worth 70% less? And so the underlying issue that people are talking about, private credit, is largely a function of the lack of liquidity, the fact that there has been no mark to market at all for some prolonged period of time. And Bitcoin is the opposite, right? Bitcoin, the underlying asset that is sort of powering these new products and the returns of which are likely to potentially make them sustainable for the long run, is the most liquid asset on more timeframes than any other thing. And private credit is the exact opposite issue. So it literally couldn't be more different.
Yeah.
Again, even the nomenclature, digital credit, like it's not really a credit instrument. It's a form of equity that's higher up the stack than common, and so behaves different because there's all the protections being it further up the capital stack. So I appreciate the marketing, and I think it's good that there's a common nomenclature. I think it might be a little misleading because in my view, it's not really a credit instrument. There's no like amortization to it. Like there's no guarantee that the payments are going to be made, right? Not that there's necessarily a guarantee with anything, although some people would argue that treasuries are guaranteed. It's the basis of the risk-free rate. But digital credit as a general category, right? No matter what you call it, I think has a lot of promise because it's built on something that is much more pristine than the traditional financial system.
How important do you think building a track record of making the dividend payments over time and maintaining that target price range is for like institutional investors to really be like, oh, this is not going away anytime soon?
I think it's, absolutely critical. You could already see it in the price right now. Every month when you get closer to the X date, right? Like the price of both of them tend to be moving back towards 100, and the dip kind of intra-month when you're the furthest away from the next dividend payment they're getting shallower and shallower for each of these instruments. If you just look at the chart, you can see the behavioral change in the market as people realize that these things are going to keep paying. So I think it's month over month right now, but I think when you blink and look back in 2 years, assuming there's no surprises and they're still paying, the spreads are just going to get tighter and tighter, right? Like the range in which these things are trading can get super tight. And again, at some point they may trade, depending on if the companies sort of allow it, they may trade well above par, right? Within reason. Like I think there's kind of an interesting dynamic because you want the price to be higher because that's a sign of confidence, but you also don't want to miss the opportunity to leverage that higher price in order to add more Bitcoin to the balance sheet. And I think it's a bit of a give and take. And there's some artistry to that. There's some creativity to that. It's not a hard math. It's not just a simple math problem, right? Because you don't know how investors are going to respond to how you let the thing trade, right? So until we see these things trading at 100.5 or 101, like we don't really know what that means yet. We know what it's like when they trade under 100 because for big chunks of the month since they were issuing, they have. STRC started to trade at 100 for more days of the month and for longer periods of time leading up to the X date. And then now it looks like SATA is starting to demonstrate similar patterns. So we'll see if we even get back down to 98 in May in SATA. We might not. But if we don't, obviously it's extremely bullish, right? If it can stay between the targeted, I think they're targeting 99.
99 to 101.
101. That's today, but I know you worked this.
Yeah, no, that's really good. What do you think that means for Bitcoin if these are actually very successful?
It's a natural buyer. in the market. It's very similar to the ETF. I think the ETF is sort of one major structural component. And then the treasury companies themselves are a major component, but I was unclear to me in 2024 and for most of 25, what was the real sustainable flywheel there. I heard people saying infinite money glitch, kid analyst, many of whom I like dearly. But they would say stuff like that. And I thought it was largely like, because there wasn't a business model yet. Like selling common equity to buy an asset, put it on the balance sheet is not going to work for long periods of time. This product has the potential to actually work for long periods of time. Again, assuming the sale of that preferred and the purchase of Bitcoin is consistently accretive across time. And the big risk, of course, is that Bitcoin falls enough for long enough that the market sort of starts to question whether or not those yields are going to be paid. And then it would be self-reinforcing, like a negative feedback loop. Like people would stop buying the preferreds. You would have to stop buying Bitcoin, and the model starts to kind of unwind itself the other way. Right now, we're going the other direction from good levels where there's more interest in these products. There's more institutions there. And these products are going to serve as a natural buyer every day. So I think that's kind of the two legs right now is the ETF, which obviously has been a wild success. That's used a lot by institutions as well. Individuals can buy it, but a lot of institutional investors will access that and the options market around that. And then these treasury companies have been a buyer in the market, but I think they're not getting enough credit because I think a lot of people didn't think that they could actually sustain the level of buying that Michael Saylor and others have been doing this cycle. I think these products maybe change that narrative and maybe change some people's perspective on whether or not it's possible for Saylor to say keep buying consistently and for as far as the eye can see.
Yeah, that's an interesting point. Like looking back, Strategy made a lot of their largest buys like when Bitcoin was just ripping, because that was when they were selling common equity. Now it seems like Bitcoin had a rough, I don't know, 8-9 months or so, and Strategy has been ramping their buys during the bear market.
The success of the preferred is not predicated on the price of Bitcoin going up like every day or every week or every month. It's not predicated on being on like a parabolic bull market, which draws in investor attention, gets people to chase common equity at higher and higher prices, even if the math doesn't really work, which is what I was sort of warning people about in November of 2024. I held a number of spaces the week before Thanksgiving, including the night before the peak. I had like 1,200 or 1,300 people in that space. Where Ben Workman was actually in there. I still remember his little face popping up on spaces. And that was the day before MSTR topped at whatever, 541.
Yeah.
And I wasn't long-term negative on MSTR. I was more concerned about the level of exuberance for an equity that I thought was trading far beyond the fundamental value. And again, for the balance sheet first, like it didn't make rational sense to me why someone would be willing to pay $2 or $3 or $4 for $1 of Bitcoin that they don't even control. And I think that was largely the correct view. And it's a nuanced view because a lot of people say, well, you were just negative on everything. No, I'm not negative on everything. I love Bitcoin. I just wanted to see a sustainable business model. And so the preferreds, because the market is maybe a different group of people, they're not FOMO investors. They're not people who want to buy something because it's gone up 300% this year and they want to buy call options on it. These are people who largely just want a stable income stream that's higher than their alternatives. Those people might buy as it becomes more clear that the dividend's been paid for some period of time, and less so because Bitcoin is up, down, or whatever. And I think that gives you another level that's not so another lever that's not so price sensitive.
Yep.
To allow you to kind of continue to grow the Bitcoin on the balance sheet.
This is more of a broad question, but what's something that probably sounds crazy to most people that you think will be very obvious in 5 years?
I mean, it's a hard one, right? Yeah, like I said, I spend so much time thinking about this stuff that probably a lot of stuff that I just think is consensus probably isn't.
Yeah.
But I still think Bitcoin is going to $1 million probably by 2033 or 2035, something like that. So, however many years that is, 6, 7, 8, 9 years, could be much sooner. It's possible we're even at $1 million within 5 years. When Bitcoin does start to gain momentum and go parabolic, it moves a long way quickly. It's just been so long since we've really had a sustainable break above the previous cycle highs, right? That like people forgot that Bitcoin has these impulsive moves. And so I think if you tell most people today they should be interested in Bitcoin, they're like, well, why? Like all my AI stocks, my SanDisk and my Micron are going up. That's human nature. People were going to chase whatever's gone up recently. They weren't interested in SanDisk, by the way, a year ago. They're only interested in it after it went up.
Yep.
And they say they're not interested in Bitcoin now, but if it's really ripping again, which I think certainly it will at some point in the next few years, people will come back.
Mm-hmm.
So I think that like just continually being long Bitcoin and not just jumping to AI or all in on AI just because everyone else is doing it, I think is the type of thing. Like if you told someone Bitcoin might outperform AI stocks right now, a lot of them would say there's no way, like AI is a real product, Bitcoin doesn't do anything. There's a lot of people who still believe that.
Mm-hmm.
Whereas in my view is that AI and Bitcoin are both fundamentally physical products. They require a large amount of energy to run. And it's one of the biggest constraining factors for both of them. And they're now actually sort of fighting at the data center level to use that energy to sustain themselves. Bitcoin's a little bit more scrappy, right? So Bitcoin, you can just spin up, a miner in an old abandoned warehouse and suck power from that's not being used by anything. AI needs like a more professional data center environment with cooling and fiber and connectivity to really be useful. So I think Bitcoin, it's like the cockroach, right, of energy users, where like everybody else could be in a recession, everybody else could have trouble maintaining itself, but Bitcoin will always find a way to sustain. AI is hot right now. I think AI is probably a lot bigger than most people think even now. I think it'll be like the internet where there's another 100x or something ahead of us. It may take 20 years to do that. And there'll be macro recessions in between, which will throw people off. Every time the market goes down, 50% people are going to say, see, it's over. And then 5 years later, it'll be higher.
Yeah.
And 10 years later, it'll be much higher. And 20 years later, it'll be like 2002 to 2022, where if you bought Amazon and Nvidia and stocks like that, like Apple, Microsoft, you made a killing. Most people just didn't have the vision at that time to understand that the internet and software was going to be the biggest industry in the world, because at that time it was still ExxonMobil, right, and Chevron and Walmart and old school businesses. So I think there'll be a similar paradigm shift over the next 20 years, where some of these things accelerate far more than even people think now. Even people that are bullish on AI might be not bullish enough.
Yeah. What do you make of like the current AI explosion? Because you kind of saw a lot of it coming beforehand, and you've profited off that.
I mean, I think it's
like, how did you see it coming?
I mean, I love technology, right?
Yeah.
So I watch every emerging thing and try to understand what it is, how it compares to what's before. One thing that struck me with AI and Bitcoin is that they were sort of built and distributed on internet rails. So the technology of the internet, of like instant dissemination of information anywhere in the world, had to exist before Bitcoin would be able to exist, right? Or Uber or something, right? Like you're not gonna be able to call a car on your phone on some random street corner unless you have access to like ubiquitous information on location and, right, like who you are, identity, payments, everything has to be integrated and tied together. But once you have that, you're able to build new stuff on top of it. Bitcoin had the internet to help in its dissemination, so it grew independently and emerged organically in the free market as money much faster than any other money in human history. People may think it's taking a long time for the price to go up, but the reality is most monies took decades to gain acceptance, if not longer. Right? Gold's been around for thousands of years as a monetary metal, right? Like the reason why people largely think of it as money is because it's been around so long. AI has the internet to disseminate itself. So like a new AI application or new program, it goes viral, and like seemingly in a month or two, everybody in the world is using something that didn't exist before. So the distribution of new technologies is on much faster cycles because everything's kind of going parabolic. It's basically stacked exponential technology. So you got one exponential technology stack and then the next one, next one. So if you've been following that, as I have, I was sitting in my Stanford dorm room marveling about what I could do on the internet, right, in the late 90s, like in 1999. And thinking, man, the whole world's going to want to use Google. And I went home for spring break in 2000 and nobody used Google where I lived, right? And so I got like 50 people to use Google when I just went home for like a winter break or spring break, right? Like, and I realized then that if you were just paying attention, you could always be sort of ahead of most people in the market, because most people are just, as I said earlier, just kind of going about their day, focused very much with tunnel vision on the here and now. One of the great things about being a professional investor, full-time investor, especially in the construct I have, where I don't really have like a lot of oversight. I don't really have a lot of people bothering me. I don't have to do IR calls all the time. I don't have to catch up with a whole long list of LPs because I only have one. I'm able to just sit and think most of the time. Like I'll just sit right here out on the deck and just think during the day, and it allows you to put things in context when everybody else is like doing their work, their prescribed structured work. I'm not saying there's anything wrong with doing that structured work. It's just harder to see the progression if you can't zoom out and really give your mind a chance to wander and really consider the implications. So I just spend a lot of time on this stuff. I'm not an expert on every component of AI by any means, but I knew as a thematic it was going to be really big, really important, and that one way to guarantee basically that you can make money is to provision compute to the users of compute, which are largely these application developers, hyperscalers, the Anthropics and OpenAIs of the world. I wasn't smart enough to pick Anthropic as a winner at the seed stage, or I didn't even see the deal, right? But I was smart enough to know that if Anthropic was going to be successful, they were going to need a lot more power and compute than existed 3-4 years ago. And I wanted to be heavily involved in the companies that were going to do that. To me, it's like selling shovels during the gold rush, so selling Levi's jeans and a pickaxe to the people that are going to go like pan for gold in the river, right, in the 1840s or something, right? And this is a modern day gold rush for sure. Yeah. And I don't think it's anywhere near done, by the way. I think the next 2 or 3 years could be insane. Like I think the next 2-3 years could be something analogous to the late 90s. Okay. Where we might be in 97 right now, we might be in 98, we might even be in 99, we might even be mid 99. But at worst, we probably have 3 to 6 months of like very positive sentiment as things turn going into the SpaceX and Anthropic and OpenAI IPOs. And maybe at best, we might have 2 or 3 years just mirroring the CapEx cycle for AI, which is still going parabolic right now and likely will for at least another 1, 2, 3 years. Now, the market may top for certain things way before sort of the CapEx cycle does. But if you go back to 2000, the AI data center, the traditional data center CapEx turned over right around the time that the stocks turned over. So it's been a pretty good barometer historically of like when cycles return. And I would argue that the CapEx cycle signaling like much higher prices and probably at some point some form of mania that mirrors what the .com kind of bubble felt like 26 years ago now.
If we are going into some sort of like, 97 through 99 period where markets do exceptionally well, are you going to try to like time the market near the peak and try to reposition your portfolio, or how are you going to think about that?
I'm always repositioning at the edges. So I'm always trading around the core, trimming, rotating. Like I did a little minor rotation in Q4 last year where I went into a number of things that I thought were deeply out of favor. That worked out really well, right? Coming to this year, like stuff that sucked in Q4 was doing great in Q1. And then I rotated a little bit back out and back right into my core AI, Bitcoin type of stuff that I think still has some way to run. So yeah, I mean, I do this for a living, so I don't just sit totally still. If you look back to Q1 23, though, my biggest 2 positions are still my biggest 2 positions now. So while there's some movement around the edges in terms of turnover, in terms of new positions and sizing changes, the general ideas follow a much longer duration. So what I would do, though, is if, let's just say, we go into like a late 90s kind of mania like we saw with the .com bubble, and some of the stuff I own goes up another 10x or something, I'll be trimming them into that. And when I sense that everybody wants to own those stocks, those positions will be much smaller on a relative basis than they are today. And that's the artistry of investing, right? There's no rule for that. You don't even know, you'll never know until after the fact. Obviously, if you knew for sure what was going to happen in the future, you could trade it perfectly. It would actually be totally optimal to trade more if you knew for sure on what day each one of the equities that you own, for example, was going to hit their high price for the next 5 years. Because you would just buy the most levered instruments to create the most convexity. So you buy out of the money calls, the ones that had the biggest variance between where we are now and where you knew the price was going to go. You'd buy out of the money calls and try to pull them in as tightly as possible because you get the highest return if you don't buy leaps that are way out. And then you would sell everything as close to that price. Now you won't, if you have large positions, this is the thing a lot of people don't get if they're trading like 5,000 shares at a time or 10,000 shares at a time. But if you have 5 million shares of something, even with block trading and dark pools, like you may not be able to get out of all that position in the same day. And if you do, you'll move the stock. So your realized price will actually be lower than if you were more careful and you did it over the course of a week or two. But you don't know that, right? So because you don't know that, it's always a probabilistic analysis. So I'm always looking at, is the stock like trading at the level that I actually think is the right level? And then secondarily, if I overlay sentiment and some of the other heuristics on it, does that really match up? Mm-hmm. So if a stock is trading well below where I think its intrinsic value is, or what its value likely is to be in 2 years, and sentiment is really negative, it's always a buy. If I think the stock is trading near where I thought it was going to be trading a year or two ago, and sentiment is very bullish, then that may be an opportunity to reduce it. But I don't think we've seen, since basically 2021, I do not think we've seen a traditional bull market in any sense.
Yeah.
The ISM PMI only briefly went over 50. The rates, short-term rates were in the 4 or 5% range, right? The Fed funds rate, which the Fed had raised rates 500 basis points in quick succession, was one of the fastest rate hiking cycles in history. They may need to do that to contain inflation because of all the stuff that we did to bail out people in COVID, and basically just the ZERP and the money printing and the QE we've been doing for basically since the great financial crisis. But in doing so, they really created like a truncated bull market. We've had like a re-rating and a little bit of a ratchet back to normality over 3 years, but I don't think we've actually had the completion of anything that looks like a normal economic cycle or business cycle. And so what I think we've just experienced is actually just like a mid-cycle style blip that's ultimately going to lead to a release of compression in the coming, say, 3 to 6 months on the short end, and maybe up to a year or two on the long end, that'll actually cause the completion of the move. And you'll know it's completion of the move because there'll be a broadening of success in the economy beyond AI, right? So you'll see, like we saw at the beginning of this year, you started to see other components of the S&P 500 besides technology start to outperform. You saw the equal weighted S&P outperforming the market cap weighted. You saw small caps outperforming large caps, some international markets outperforming the US. Those are all signs of a market that's actually trying to transition into a full scale bull market. You'll also see signs like everybody you know will want to talk about Bitcoin.
Yeah.
Everyone you know will want to talk about stocks. Everyone you know will want to talk about crypto. And most people are largely just not paying attention now. It's not what the end of a bull market or a bull cycle typically looks like. Those heuristics aren't perfect, but it's really, really hard to get a serious, long, drawn-out bear market without anything that looks like traditional bull market euphoria. So I'm still pretty confident that's ahead. And a lot of the returns, just like in the late 90s, could come at the very end. So it feels like you've made a lot of money if you've been in NVIDIA, or if you've been in IREN, or if you've been in MSTR from the bottom of the cycle, like Q4 2022, right? But that might not actually be the move. And actually the most substantial part of it could happen in the last 3 to 6 months before the actual more painful, like year-long bear market.
Yeah.
That's kind of like, again, these are all probabilistic. So this is just the weighting that I'm giving that the highest weighting because that seems to be the most likely outcome from my perspective. But that's not to say it might not happen totally differently. I will adjust as I get more data, right? Like life is all about how the cards flip over across time, to use a Vegas analogy. And so what you're always trying to do as an investor is buy as much time as possible, because the more cards you can see flip over, the more certainty you get about the outcome. You make the most money by betting before any cards come out, but you get the most certainty as all the cards come out, right? Because you get to the 51st card or something, well, you almost know for sure, right? You know for sure what the 52nd. If you're counting, you know exactly what the 52nd card is. If there's 48 cards out, you can narrow it down with high likelihood, right? If there's only 2 cards out, well, you've got 50 more cards to come. So you might make more money if you choose correctly, but the odds of choosing correctly are lower. So everything investing is along that spectrum. And so over time, like you're going to see more cards come out. We're going to see, does OpenAI get public? We're going to see, does SpaceX get public? How do they trade? It seems like there's a lot of demand in the private market. It seems like there are a lot of people that have cash and want to invest in stuff, and they're looking to try to pile into some of the stuff. If I'm right, that means markets are going to go a lot higher before they go lower.
Yeah. Yeah. I mean, last year, I think a lot of people expected Bitcoin to have a great year.
Yeah.
Gold ended up, me too. But gold ended up having a pretty great year last year. Do you think it's Bitcoin's turn at this point? Like, what do you make of the gold outperformance over Bitcoin over the last, 18 months at this point?
Gold's outperformed Bitcoin in a lot of the previous cycles. And then when it stops outperforming Bitcoin tends to go into its bull cycle. There's also a correlation between gold and copper that is trading near its kind of long-term trend line that the technical guys show me, where when copper starts to outperform gold again, that's also a good sign. for Bitcoin. As I said, I think this is all linked to the business cycle and the fact that we really haven't had one because of sort of external macro and structural factors that are largely not about Bitcoin, but do affect liquidity, at least liquidity that'd be interested in Bitcoin and crypto. We haven't had a bull market in crypto at all, right? So the broader crypto ecosystem, Bitcoin's been okay because of the ETF and treasury companies, which have largely benefited Bitcoin over any other crypto asset. The rest of crypto, like everybody's giving up.
Yeah.
They haven't made any money since 2021. They're literally giving up. Sad. Some of them. Yeah, it's sad for them. They would have been better off just buying Bitcoin. But Bitcoin would benefit if those things would go up too. Like Bitcoin would go up a lot more if those things were going up. So in a weird paradoxical way, even though I don't personally support most crypto and meme coins and things like that, I am wanting them to go up because when they're going up, Bitcoin will be 200,000, 300,000, 400,000. In order for Bitcoin to get to 1 million, unfortunately, there'll be more meme coin cycles and more crypto cycles. It's just a nature of an asset class that's emerging.
Yeah.
So that's what I think is going to happen. I'm remaining bullish here. I've managed to do pretty well even with Bitcoin drawing down. So I'm not 100%. Bitcoin in the AI data center space has been quite firm, even with all the volatility. I think we have a Fed meeting like right now.
Yeah.
I'm so glad we scheduled this during the Fed meeting because normally I'd be watching Powell bloviate about all the conversations he had with his friends at Goldman Sachs and telling us that he's really doing that for the benefit of the American public. But I didn't have to listen back to that.
Perfect. Good to hear. I think it's his last meeting.
It should be his last one.
Yeah.
And then we get Warsh in there and we'll see if he's able to move the needle and get the other Fed governors to agree with him that maybe we can loosen conditions a little bit.
Do you think that will be a big deal, or is he just like another, cog in the wheel and what's going to happen is going to happen?
I mean, he's an independent guy, so he may have said more or less the thing that Trump wanted to hear, but we know like Trump doesn't agree with what the Supreme Court justices often say, even after he put them in there, right? Like, thank God the American system works the way it does. It is the best non-decentralized system of governance in the world. I'd say Bitcoin is the best governance system, but the U.S. government's probably the second best system, right? It just works over long periods of time. It's been very productive. And so even though I don't love the idea of a central bank and I prefer both currencies that emerge in the free market and interest rates being set by the market, I understand that it's not going away anytime soon. And all things being equal, I'd rather have someone in there who's going to manage rates and manage the balance sheet for the benefit of the normal person and not for just asset owners and the wealthy and bankers. No matter what Powell says, a lot of the things he's done while he's been in there have benefited banks, have benefited the wealthiest people. And so I think I could see a scenario where Warsh tries to decrease the balance sheet, but also lowers rates. The lowering of rates actually will help small cap companies, family businesses, individuals, right? And the shrinking of the balance sheet might actually hurt some larger asset owners, but might have the net benefit of sort of balancing out the economy. I don't think Warsh versus Powell is going to be the reason why Bitcoin goes to 200,000 or 300,000. I think that's largely just a long-term adoption story combined with time, but it might be a catalyst for like a new phase of sentiment.
Makes sense. Last question. Looking forward over the next 5 years for the future of America and humanity, are you optimistic or pessimistic about the future?
Oh, I'm super optimistic.
Yeah.
I don't think you can make a lot of money being a bear.
Yeah.
Like look at Michael Burry and Jim Chanos. Like they were famous because they called one thing in the last 25 years.
Yeah.
Like Chanos called Enron, right? 25 years ago. And Burry called like 17, 18 years called the Great Financial Crisis. Now those are great calls, but the reality is if you followed almost everything else they did, they were almost like net negative when you blend it out. So, and Chanos is mostly given back most of his net worth. He's had to give up all of his properties in New York because he lost so much money. And it's fun. It turns out it's really hard to be bearish. Even great short sellers will tell you that it's sort of like a negative carry business because you're always paying the expense of borrowing stock. You borrow stock as a dividend, you got to pay the dividend to the holder, right? You're fighting against the natural reverse gravity of markets, which is that high quality assets and usually the whole market in general tends to increase in value over time, to some degree because there's real growth in some of these stocks, and to some degree because the dollar's debasing. So the combination of the two causes this sort of natural like move. It's something like rooted in physics almost. And so when you're short, you're betting that you're smarter and you're going to outrun. You're going to be able to jump and go higher than gravity will actually allow you to. Gravity is just going to push you back down. Even if you're Michael Jordan, eventually you're going to come back down. And I would say shorting is like the reverse of that. Like thinking that you're going to correctly cause things that go down a lot, when in reality, on average, most things go up. And so I just think it's negative asymmetry, right? You're decreasing your odds of being successful in the long run. You're decreasing your odds of being wealthy. I personally enjoy not having to answer to anyone every day, and waking up every day and having my time be my own. And that's only possible if I continue to be an optimist. It's not possible if I succumb to bearishness or listen to chart squigglers or kid analysts trying to scare me out of stocks every 3 weeks.
I like that a lot. Well, Mike, thanks so much for taking the time to do this. This is an incredible conversation. Any final closing thoughts?
Nothing beyond, I mean, you covered a lot. I'd say stay long Bitcoin, stay long AI for the long run. It's going to be hard to lose too much if you stick with it and don't get off the ride in the middle of the ride.
Love it. Well, thanks. This is great.
Thank you.